everybody? This is Jake Stenziano, host of the Wheelbarrow Profits podcast, here with my co-host, the multifamily mentor, the coach, the chef, the father of six, the best-selling author, the G-Daddy, Gino Barbaro. Gino, how's it going?
I'm doing great, Mr. Stenziano. How we doing?
Always making it happen, big man. Today's guest is Joe Fairless. Joe is an apartment investor who controls over $54 million in multifamily assets. His investment focus is the syndication model. Joe, this is the second time you've been on the show, but some of our listeners may have not heard the first interview. Please give us a quick summary on your real estate background.
Yeah, sure. So we've closed on we're closing on a property next week, and then we closed on a property 2 weeks ago. So it's actually going to be total value of over $100 million.
Bling.
In about 10 days from now.
All right.
Fantastic.
Now, based on purchase price, it's around $82 million, but I think where the value is right now is over $100 million. Let's see. My background, really simple. Keep it short and sweet. I am from Texas originally. Went to Texas Tech, then moved to New York City. My major was advertising, English minor. Lived in New York City for 10 years. Became the youngest vice president of a New York City advertising agency. Then wasn't digging it anymore, wasn't fulfilled. I'm a huge Tony Robbins fan. Actually, I have a coaching call with my life coach after we hang up on this call through the Tony Robbins program. And I got into real estate investing towards the end of my advertising career. I started with single-family homes. First house was a 4-bedroom house in Duncanville, Texas, which is in Dallas, south of Dallas, about 15 minutes. Bought it for $76,000, and then decided to leave the advertising industry. When I left the industry, I realized that I couldn't get a mortgage on a single-family home, but ironically, I could buy large apartment communities with investors. And so that was my approach. Started with the property in July of 2013, and then my latest closing was 2 weeks ago on a 296 unit, and then next week we're going to be closing on a 217 unit.
Sweet.
Wow, that's awesome. So, Joe, you do real estate syndication. Can you explain to the listeners exactly what syndication is?
Sure. Yeah, syndication is something that we've all likely participated in already if we have flown from point A to point B. Think about it as a way to participate in something much larger than you could if you didn't go in as a group. So, for example, when you fly on a plane from wherever you live to wherever you want to go, you are paying a small fee relative to the amount that the airplane and the fuel costs to take you from point A to point B. Therefore, you're all syndicating the ride because you're all participating in something that you want to accomplish your goals. I do multifamily syndication, so I buy apartment communities with investors, and we share in the profit. So we buy large apartment communities, we all put in money, and then we buy it together, and then we share in the proceeds or the profit.
So how did you get into syndication? What was that aha moment that said, wow, syndication is for me. I love this model?
Well, there wasn't really a choice because I didn't have the money to buy a large apartment community. And I realized that with single-family homes, I was making $250 a month on the homes if it was a good month. And then when a resident moved out and I had to pay $5,000 for all the make-ready costs, then that wiped out a year and a half worth of profits. So I realized like buying these single family homes for me personally wasn't working. And we can make money in any type of real estate investing. I know I've interviewed people on my podcast who have, but it just wasn't for me. I didn't want to get into the single family home game. So I saw that with large apartment communities, I can raise money, buy them with investors, and there's an art to a science. There's an art and a science to it, so I figured I'd learn it, and been following the process ever since.
Joe, how did you start learning about syndication? Who were your mentors at the time when you first started out?
I had a lot of people that I learned from. I read a bunch of books. I listened to – actually, I didn't listen to podcasts because I don't know if the Bigger Pockets podcast was around in 2009. And well, actually, no, I started syndication. I started investing in 2009. Started syndication in January 2013. So I think it probably was around then. But I wasn't listening to podcasts then, although I do now. I was reading books, and then I was reaching out to authors of those books. I was hiring consultants on a formal basis, or I was working with people who I came across who were doing what I wanted to do. For example, in New York City, there are some people who I came across who were doing that syndication on a much larger level. So I'd get introduced to them and just start learning that way. It was a combination of both people and then also a lot of books. Like I believe I've read every book that was published, at least at that time, on multifamily investing. So I was just a bookworm, and then I was reaching out to the authors of those books.
That's great. Can you tell us about your most recent syndication deal? This one that you're going to be closing on upcoming?
Sure. Yeah, this one that we're closing on is a bit interesting, it's a little interesting, but a lot different from what we've done in the past in one aspect, and that is that we have an investor who has invested with us on 2 previous deals. And when I say us, it's my business partner and I. And he wanted to, after investing with us on 2 previous deals, he's like, okay, this is great. I'd love to do another deal, but you know what? I want to be the only limited partner on the deal. So as a result, he is bringing all the equity from a limited partnership side. We're investing on our side too, but he's bringing the limited partnership equity, and he's the only investor that we have. Whereas on our other deals, we have a group of investors who all bring in at anywhere from $50,000 to $3 million. But on this one, he's the only investor on it, and he's bringing in the majority of the equity.
So what does the deal look like as far as what are you projecting cash-on-cash returns, your debt coverage ratio, all those numbers? What does it look like?
Yeah, so on this deal, the projected cash-on-cash return, how we look at it is from an internal rate of return standpoint. Okay. So when we go into a deal, we look at the what is the projections over 5 years on an internal rate of return. And then we can obviously look at the annualized cash-on-cash return after that. And with the internal rate of return, how we structure all of our deals, or what we look for, is at least a 20% internal rate of return to the limited partners. So the project would need to have greater than 20% internal rate of return to the overall deal, so that we as general partners can also make money. So with this deal, it's projected to meet or projected to exceed that 20% internal rate of return on for the limited partner. And then how we structure all of our deals, and this one as well, is there's an 8% preferred return, and then an equity split above and beyond that, based off of performance hurdles. And the business plan for the deal is that we are projecting to put in $5,000 a unit and increase rents around $75. And what we always want to look for is, with our deals, how much. First off, what's the opportunity? Because we get there's a lot of opportunities that we pass on, a ton of opportunities, as I know you guys do as well, that you pass on. And so what we look for is stabilized properties that have a value add component to them. We like to do deals that are built 1980 and earlier, or I guess later, 1980 to today, where there's not as much deferred maintenance, assuming that it's been owned by a good owner, and that there's some value add upside. So when we look at it, we look at it from the internal rate of return metric, and then we go from there.
So what attracted you to this deal? What made this deal look good or different? I mean, what market is it in? Is it unit mix that you liked? Is it potential to raise those value adds? What was really attractive in this?
Well, yeah, it's in the Dallas-Fort Worth area,
Mhm.
and that market is very competitive right now. The reason why it's competitive is because it's an incredibly stable market with a lot of projections for job growth and population growth. There's also a very diverse economy. I am originally from Fort Worth. I grew up in Fort Worth, so I know the Dallas-Fort Worth area pretty well. And as a result, it's more challenging to get opportunities in Dallas-Fort Worth where you've got that inside track. Because if you're an owner, I mean, just using common sense, if you're an owner, why the heck would you sell a deal without a broker? Why would you go off market with someone when you can go bring on a broker and then publish that and create a bidding frenzy and get the highest dollar? In most cases, it doesn't make sense. Well, in this example, though, what happened is we had a relationship with the owner of the deal. We actually bought one of our previous properties from the same owner, so this owner knew that how our style worked. They knew we'll close. They know we won't retrade or renegotiate after we do due diligence, and they know that we're not a headache to the seller whenever we go through the process. So what happened is we had our limited partner who wanted to invest in something just with us and not with any other limited partners. And we went to a broker that we have a good relationship with, and it just so happened that this broker had just got awarded this deal from the owner that we knew.
Uh-huh.
And the broker said, here's what I'm going to do. I'm not going to create the marketing package yet. I'm not going to send it out to anyone yet. Why don't you go take a look at the property and then go talk to me afterwards, and let's see where you're coming out at with an offer price, and then we'll see where based on his conversation with the owner, where they're at, if that's close to where they were looking. And so we did that, and we were able to make an offer and get it accepted prior to the deal going on market. And how that saved money for us is that the broker took less of a commission because he didn't have to do as much work on it, because he didn't have to market it. He didn't have to go do all these tours. He didn't have to create a marketing package, field all these calls. It was simply a one-off, phone call that we had with the owner, and we were able to get the deal wrapped up. So the things we look for are unique opportunities like that, where we can get in with our relationships or with our on-the-ground management and really find some sort of unique angle that others aren't able to find, or if they are able to find it, aren't able to execute on it like we did in that example.
That's awesome. Joe, let me ask you a question. If I'm a new investor and I'm looking to get into the syndication, what would your advice be to me to get into this game?
Well, depends on how new you are, because you can do a multifamily syndication deal if you have one of two things. One is a real estate track record. Two, and by the way, both is best, or two is if you have a successful business track record. Now, even if you have both of those, you're still going to have to know the process. You're still going to have to know how to structure the deal. And so my advice to you, if we have a listener who's wanting to get into it, would be read every book that you can get your hands on the multifamily business. For one book I really like is The Complete Guide to Buying and Selling Apartment Buildings by Steve Burgess. Another one is Turn Your Money Pit into a Money Maker by Craig Haskell. Dave Lindahl, Multifamily Millions, a little bit salesy, but still has some good information in it. Those are 3 books just off the top of my head that I would recommend. And once you've established that foundation for how to approach the business, then it's simply a matter of knowing the exact syndication process. And I'll tell you the syndication process right now is you establish your goal. You know what success looks like at the beginning. Then you make sure you're really good at underwriting deals. Once you know how to underwrite deals, then you identify the 1 to 2 markets that you want to invest in. Once you identify the markets, then you start building your brand, because as a multifamily syndicator, you also have to be a good marketer, because you're building a company, you're building a brand with investors. So when people Google you, you want to have a good presence. So you build your brand by having a website, a logo, a business card. Once you complete that, then you start having investor conversations. You make sure that you get the investor conversations done first before you look at any deals. It's a freaking waste of time to look at deals for purchase if you don't have your money lined up. That's one mistake I made at the beginning, and that's a question I get a lot. Should I get the money or should I get the deal first? It's a character building experience if you get the deal and then try and find the money. I'll tell you that right now. I've done it personally. I've done it both ways. So you have the conversations. You don't raise any money. You don't transfer funds from investors. You simply talk to them about your business plan and your business model. Once you have more than 30% verbally interested, so dollar amount verbally interested, then more than 30% than what you need, because there's going to be some fallout. Then you go and look for deals, and you start building the relationships with brokers in those markets. You run the numbers on 100 properties in the 1 to 2 markets that you're focused on, and then you start making offers. Then you do due diligence, then you close on the property, then you do asset management, then you do it all over again.
Wow. I mean, I think the easiest way for me to do it was maybe to buy a duplex or a small little multifamily where I have a little credibility. We build a credibility book, and then you're in the game. So at least you have like a 10 unit or 15 unit going on. I think from that perspective, it might be easy to start the multifamily syndication instead of jumping right in. But I knew you jumped right in. I knew you started from the beginning, and you had a set of goals, and you really educated yourself. And that's what stands yourself out from a lot of other people, where they think they're just going to start talking about deals, and they don't even know how to analyze the deal, how to raise the money, how to get the operating agreements, all those documents together. Then once you buy it, the pain's just started, because then you got to learn how to manage it, or you have to find the management company. So I guess you can go both ways, but I like the way you've laid it out. It makes a lot of sense. Get yourself educated. I mean, how long were you reading these books before you actually pull the trigger on a deal? Because you're talking about a lot of education there.
Yeah. Well, I can tell you, before I bought any property, so before I bought an apartment community, I'd purchased but I did purchase 4 single-family homes. I mean, it might not seem like a lot, and it probably isn't, but I did 4 different transactions, and then I went straight to a 150-plus apartment building. But I'll answer your question directly here in a second, but I need to mention that before I even bought a house, this was in January of 2009, whenever I was pre-approved, had the money in the bank, finally saved it up after 3 years. I had $20,000, and I was ready to go buy a house. Well, I didn't actually close on the house until October. So it took me 10 months just to buy my first house once I started looking. And it took me 3 years to get to that point after I knew I wanted to do it, just to save up the money. Therefore, there was a long, in my mind, now, in the big scheme of things, perhaps 3 years to save up money and then 10 months to actually buy something isn't a long period of time. But in my mind, that was. As far as once I started studying multifamily, how long did it take me to actually close on something? Well, my education from 2009, when I first started buying, through my purchase, I mean, it was basically starting from that point, because I was looking at single families and then also I think some of that transfers over to multifamily. But once I started really being focused on multifamily, it took 9 months from the point of, okay, now I'm reading everything I can, like studying every single waking hour after I get off of work. And on the weekends, while my friends were going out, I was either studying or I was babysitting. I had a part-time job on Sundays to make extra cash babysitting in New York City, just to help put more money towards my real estate endeavors. So it took me 9 solid months.
Wow. I have one more question on as far as the syndication aspect. How are you managing these properties? Because I'm sure a lot of people like to have stuff in their backyard and they can't envision how they're going to actually manage a 200-unit property. How are you handling that aspect of the business?
Yeah, and I'm glad that you asked that question, because I want to just blow up a myth about multifamily investing. It is not passive. It is not passive at all. Even if you have a management company, if you're doing the asset management properly, so if you're managing the property management company properly, you are not taking a passive role. You are taking an active role in overseeing the business plan that should be implemented. And how we manage these properties, I'm in Ohio. I live in Ohio, and the properties are in Dallas, Fort Worth, and Houston. So we have a property management company. We do the asset management. We oversee them. My business partner or I will visit the property on average once a month, which is fairly frequent, but we're just staying very close to these properties, and we want to make sure that everything's being implemented properly.
And what other markets are you looking at right now?
Looking at anywhere that's not on a coast, pretty much. So southeast, midwest, southwest, and direct south. But primarily in Texas, because that's where I feel we have a competitive advantage for reasons I stated earlier. My background and relationships we have with brokers, as well as the jobs and job diversity that's taking place in particular in Dallas Fort Worth. So because of those reasons, where we've been focused on those markets, we also, I got an off-market deal presented to me, a legitimate off-market deal. 90% of off-market deals are not off-market deals. This is a legitimate off-market deal that would be the largest deal that we have ever bought, and the largest so far is a 320 unit. So it's larger than that, in Columbus, Ohio. And we're underwriting that right now. So we if there's an opportunity, we're going to follow the opportunity and qualify or disqualify the market after looking at the opportunity. And if the market is disqualified, or if we can't find a good management partner, then we're going to move on.
Hey, so this is a little joke for Jake. I gotta give this to Jake. He's looking at any area on the electoral college that's red, because basically all the blue states are on the east and the west coast, right? No job growth, high taxes, right? High government reach. He's basically looking at all the red states. Midwest, you're looking at job growth, you're looking at low taxes, you're looking at that's how I take that. I know Joe didn't say
all right,
that.
We're moving on, not to isolate any of the listeners now. Hey, Joe, real quick, I know you got your life coach. One question I want to ask you. You've been investing for a handful of years now. How has real estate changed your life, and what has it done for you?
Well, it has let me spend more time with the love of my life, soon to be, fingers crossed, soon to be fiance. And it has allowed me to give more than what I was able to give whenever I had my vice president position at an advertising agency in New York City. And those are the two most important things in my life. And it's allowed me to do more with each of them.
Time freedom, baby. Hey, we got to run because I don't want you late for your Tony Robbins coach. This has been awesome. Thank you so much for your time, and let's do it again. Thanks
a lot. And by the way, for anyone listening, you can
I'm sorry. Yes, tell us where we can get a hold of you. Your coach will appreciate it.
Yeah. Well, there's a free resources guide that I'd be happy to give to all of your listeners. Just email info@joefairless.com, and it has all the resources for apartment investing that that I look at when evaluating a market or a deal, or even some of these books that I mentioned. So info@joefairless.com. If you email us, then my wonderful team member Samantha will give you that information.
Check it out. Joe is the man. We appreciate your time.
All right. Thanks a lot, you too.
Thanks.
Thanks, Joe.